Good afternoon, everybody. I'm going to set the context first of all. What is a lifequake? So each one of us will go through dozens of events that are going to disrupt our lives. Normally, we have one every 12 to 18 months, and some of these might affect our finances. Now, we have those that are voluntary that we plan for. So that might be moving to a new job or a home or having children. But we also have those involuntary events as well, such as maybe getting a medical diagnosis or being made redundant. And according to research, 1 in 10 of these events might become a huge life event. And these are what are known as lifequakes. So the purpose of today's session is to look at how we can protect ourselves financially against those involuntary events, or lifequakes as they're sometimes known. So we're going to be looking at making the most of those employee benefits that give you financial protection and what insurance options you have to fill the gaps. We're going to be looking at avoiding scams along the way, and then the importance of having a will in place to protect your loved ones. Now, the starting point is to think about what protection you need if that lifequake were to happen and you weren't able to work or your income dropped. Now, everyone's circumstances are going to be different. There won't be one size that fits all, but ask yourself the following questions. Do you have any savings that you could use to cover you? Or are you in that situation where actually you've got debt and that would still need to be paid if your income was to drop? In terms of your family, who do you provide for financially now? Is it a partner or children? Or are you one of those third of adults in the UK who are in that sandwich generation where we're financially responsible for our parents or our in-laws, and either we're paying for their care or helping with their support needs, whilst we've still got children at home and in full-time education? So think about, what money would your dependents need if you weren't able to provide anymore? Would it be a monthly income? Could it be a lump sum? And the very first port of call is really thinking, what benefits do I have available through work, or do I need to take out any insurance myself to fill those gaps? So let's start by looking at the standard benefits that most employers provide to give you financial protection. And normally they are the pension, the death in service benefit, and sick pay. So starting with a pension scheme then, well, every employer in the UK has to automatically enrol you into their pension scheme. If you're working for them, you're over the age of 22 and you earn £10,000 a year or more. Now, for most employer pension schemes, you will need to pay a contribution every month, and then your employer will put in some money on your behalf too. And of course, the main aim of a pension is to provide you with an income later in life, for either when you choose to reduce your working hours or stop altogether. And at the moment, under UK law, you can choose to take an income from age 55, even if you're still working. But the government are looking to increase that age to 57, and that comes in 2028. Now, any money that you do have in your pension pot at the point that you choose to retire, you can take up to 25% of that as a tax-free cash sum, and then the rest you just keep invested and draw an income from the pot as and when you need it. So let's look at the pension then from a protection point of view. So if your income were to drop and you're over the age of 55, you do have that option to start drawing a regular income from your pension pot if you want to supplement your income. But of course, the sooner you start drawing from it, the sooner it is likely to run out. And it's also really important to understand what would happen to your pension savings if you were to die. Now, if you were in the type of pension scheme that's known as final salary or defined benefit, and these are few and far between now, which is why I haven't mentioned them up to now, but any benefits that would be payable to you on death will depend on the rules of the scheme, but often there is a lump sum payable to your nominated beneficiaries. However, if you were in one of those pensions where you build up that pension pot, the good news is that the full amount that you've saved in that pension, including any employer contributions, could be returned to the person or people of your choice, and they get that full amount free of income and inheritance tax. And that really is one of the major advantages of pensions, is that any money saved in there sits outside of your estate for inheritance tax purposes. So the main action here in terms of protection is make sure you keep that pension nomination form up to date, particularly if your situation changes, things like you get married or divorced or have children, just to make sure that any benefits that are payable go to the right people. Now, if you can't remember whether you filled out a nomination form or you think actually it might be the wrong person on there, just contact your HR department and they should be able to point you in the right direction as to how you can go about doing that. The next benefit that a lot of employers provide is death in service. And this is a life insurance that pays a lump sum to a beneficiary of your choice in the event of your death. And it's really there to give you that peace of mind that a loved one would have financial security if the worst were to happen. Now, a lot of employers in the UK tend to cover you for a multiple of your basic salary, somewhere between 2 and 4 times your salary being the norm, but it could be higher, it could be lower. And the really good news, if you do get this through work, is that your employer normally pays for it and you're not taxed on that benefit. So it doesn't appear on your P11D, it doesn't reduce the amount of income you can earn tax-free. However, if you are in the situation where either you don't get it through work or you only get a very low level and you might want some more, I thought it'd be useful to put up a comparison of how much this type of insurance would cost you if you needed to buy it yourself. So in the example on the right-hand side, you can see I've got some indicative figures for someone who's a non-smoker. They want a payout of £100,000 to go to their beneficiaries in the event of their death. Now, generally with this type of insurance, the younger you are, the cheaper it is because, let's face it, you're less likely to die from an illness when you're young. So for a 30-year-old to be covered for 20 years, the indicative cost is around £5 a month. And that goes up to just over £20 a month for a 50-year-old. Now, if you wanted to be covered for the whole of your life, which means there's no end date, that cost can jump considerably, as you can see. So for that 50-year-old, it could jump up to kind of over £80 a month. But if you are going to take out this insurance yourself, you will need to fill out a medical questionnaire. And often this isn't the case if you get the benefit through work. So your action here is really find out, is this something that you get through work? If you do, you might also have the option that you can increase the cover at your own cost if you want to. But most importantly, again, there will be a nomination form that you need to fill out to let the trustees of that scheme know who you want the money to go to. So just think about, have I got enough to protect my family financially if I wasn't here? Should I be supplementing what I've got already with additional life cover? And often you might have some in place anyway, because anybody that's got a mortgage is often asked by the mortgage company to have life cover to pay off the mortgage in the event of your death. And we're going to be looking at some tips of getting the right insurance in a few slides' time. The other benefit that a lot of employers offer is sick pay, and this normally pays your salary for a specified period of time if you're unable to work due to illness or injury. So the best thing you can do there is just check your employment contract, see if you're covered for sick pay, and if so, how many days you would be paid for if you were unable to work. If you don't get cover through work, then you might be eligible for statutory sick pay from the state. And that's just over £96 a week, and that can be paid for up to 28 weeks. And that kicks in after the 4th day of absence. If you're self-employed, then you might be eligible for the employment support allowance, provided you've been paying national insurance and you meet their criteria. But that's at a lower level, that's at around £74 a week. And really my point for telling you that is that although there are state benefits there to help you, they're unlikely to provide you with a decent level of income for any period of time to provide for you and your family while you might be ill. So although your employer might provide a good range of benefits, definitely look at those because they're going to be a really good starting point. You might need some other things as well. But the place to start is build yourself a financial fact sheet. Write down all of the protection you've got in place, either through work or outside of work. And also write down, in what circumstances it will pay out. Make sure you've added on who you should contact in the event that anybody needs to claim on that. And most importantly, make sure your family know where to find that sheet in the event that something happens so that they can access the benefits if they need to. Once you've got that financial fact sheet, then compare that to what you think your dependents would need. Compare it to the income that you've got now, because this is going to let you know if you've got any gaps that need filling and whether you need to look at further life cover, income protection, or critical illness policies. Now, when I speak to people often about protection insurance, I do get met with a bit of cynicism, and the first reason is most people say, well, hang on, they never pay out. Insurance companies always find a reason not to pay out the insurance that you've provided. In reality, over 97% of protection insurances were paid out last year, and that was over £13 million a day to policyholders. The most common reason why insurance claims are declined is because the person taking out that insurance hasn't disclosed medical conditions. So if you're in doubt about whether to mention it, do. Worst case scenario is they'll probably exclude that medical condition from the insurance, or it might just be they put the premium up £1 or £2 to cover that as well. In some circumstances, they might say, thank you for telling us, we'll cover it anyway. But if in doubt, do tell your insurer. The second myth is, I'm not going to need insurance. Nothing's going to happen to me, because actually most of us are optimistic creatures. But unfortunately, if we do look at that pie chart on the right-hand side, you can see that most critical illness claims are between the ages of 40 and 64. And actually the people that claim the most are between 45 and 49. And I'm slap bang in the middle of that now. Every year, nearly 1 million workers unexpectedly find themselves able to work because of illness or injury. And really, those state benefits are unlikely to fully cover the salary you've had. The third option is, I can't afford it. But actually, protection insurance, particularly life insurance, is generally cheaper than most people think. And we saw that on the examples that I went through. So it really is well worth weighing up the cost of insurance policies against the potential benefits, including that peace of mind and security for your family. Now, we've already been through the pension, the life cover, and the sick pay. I now just want to look at a couple of other things, namely income protection and critical illness, just so that you can get a better understanding of what they do and why you might need them. So income protection insurance, that is designed to support you financially if your income were to drop because you can't work due to illness or injury. Now, this type of policy is particularly relevant for anybody who might want to provide an income for themselves after a sick pay policy from their employer would stop, because often they only pay out for a certain period of time. Now, the key here is the longer the waiting time before the insurance kicks in, the cheaper the policy is likely to be. It's also cheaper to get a short-term income protection insurance, so let's say one that pays out monthly for 5 years, rather than asking for an insurance that will pay out until you get to retirement age. But if you did decide that this is something for you because you don't get it through work, just to note that most insurers won't allow you to insure more than 60% of the salary that you get full time. And that's very simply because they want you to have an incentive to return to work in the event of a claim. Now, as you can see on the right-hand side, if you wanted to buy cover for £1,500 a month as a salary, as a non-smoker, you work in an office, you would typically pay about £30 a month as a 30-year-old for that, and that goes up to £50 a month for a 50-year-old. If you're a smoker, those premiums would go up. Now, the good thing about this is that any income you do receive from a personal income protection policy is paid tax-free, and you can claim on that policy as many times as you need it whilst that policy is still in force. But to work out how much cover you need, add up your mortgage and your debts, including any credit cards and loans and other expenses, just to find the monthly amount that is your essential spend, take away any other income you might get, and then you need to look to cover the rest. But be careful not to overinsure yourself with income protection. If you've got 2 policies and together they would pay out more than 60% of your salary, you'll probably find that one won't pay out because there will be that cap. So if you've got 2 policies for income protection, you could be paying out for 0 benefits. So do check that. The other one I wanted to talk about is critical illness. And this covers you for a tax-free one-off lump sum payment if you're diagnosed with one of the illnesses covered by the policy. And these are normally stroke, heart attack, cancer, multiple sclerosis. Now, the idea of this protection is that lump sum payment can either pay off your mortgage, pay off your debts, or maybe it's for alterations to your home, such as wheelchair access if you needed it. But once that payment's been made under that policy, the policy stops. So that's different to income protection. Now, you might not need this if you've got savings or you've got a partner who could cover your living costs or any shared commitments such as a mortgage. But if you have got a partner that's sharing all those costs, are they protected as well? What would happen if they got ill? Again, on the right-hand side here, I've shown the average cost for somebody who wants to be covered for the next 20 years for a £50,000 lump sum. If they took out the policy at age 30, it's likely to cost about £12 a month, going up to £23 a month for a 40-year-old. And this really does get more expensive as you get older, because you're far more likely to be diagnosed and claim for critical illness, as that pie chart showed before. Now, just having been through the process myself to get this cover in place, it can take some time. I had somebody come to my house to do a medical. I had to send off my GP reports, and the whole process took about 3 months. So if this is something that you can opt to choose through work, it may well be worth doing. It might be more streamlined. You might get pre-existing conditions included, whereas if you take it out yourself, you may have to go through lots of medical questionnaires. So just a tip on that. Now, there are other types of insurance too. There's payment protection insurance. So that would pay off a loan or a debt if you were unable to pay it because, let's say, you'd been made redundant, or you were ill, or you were injured. So lots there to think about. If you do feel like you've got gaps in cover, if you do need to find your own policies, I totally recommend looking at Money Helper. This is the newly launched brand of the Money Advice Service. It's a government website. It provides free and impartial advice about how to get the right insurance policy for you. Loads of good articles on there. And the other place to go is the Association for British Insurers. Again, loads of stuff to help the consumer. If you are looking for a competitively priced insurance, start off by looking at comparison websites, things like Money Supermarket, Confused, Go Compare. They're a really good place to just get an indication of what that insurance might cost for you. But do remember that you've got places like Direct Line, Admiral and Aviva that won't quote on comparison websites. So just worth checking whether you can get a better price from them. So just to recap then on insurance protection, look at your own circumstances. Who do you want to protect? Check what cover you've got in place, and then look to fill those gaps. If you do decide to take out an insurance policy, make sure it's kept up to date and that you keep the insurer up to date with anything medical and any changes in address, those sorts of things. If you have got a financial advisor, this is the sort of service they should be providing for you, identifying those gaps in protection and suggesting policies that are right for you. Now, at this point, I just wanted to mention scams, because unfortunately, financial scams are on the rise. And examples include fake investment opportunities, website cloning, where you think you're on a company's website, but it's actually a replica site trying to get your bank details, and pension scams, where people are being encouraged to transfer pensions into new schemes, take their benefits early, but really someone's just getting a lot of money for you doing that. Now, the financial authorities are working really hard to combat these scams. But I thought I'd just give you some information on how to avoid them. And the best website for this is the Action Fraud website. They've got a national campaign called Take 5, which aims to provide impartial advice to help everybody protect themselves from financial fraud. And their main messages are: do not assume that an email request is genuine. If you haven't asked for that email and you get it, it could be from somebody fake. Don't be rushed into any financial decisions. A genuine bank or a genuine financial organization will give you time to stop and think about any policies that you might be taking out. And listen to your instincts. If something seems wrong, you're probably right to pause so that you can stay in control. Have the confidence to say to somebody, I want to just check out your idea. I want to make sure you work for the financial company that you say that you are. And if you've got any concerns, then you need to report those. So if you are worried that you're being the victim of a scam, or it's already happened, there's a few things you can do. Firstly, if you get a message from a company and you think that's not quite right, you think it might be a scam, you can forward it to that report@phishing.gov.uk address there. That's monitored by the City of London Police and the National Cyber Security Centre, and they've removed thousands of fake websites over the last couple of years. Then check your credit report, see if there's anything suspicious on there. The easiest way to do that is to sign up to one of the credit score apps, something like Credit Karma or Experian. If you see anything on there, like somebody's applied for something financial on your behalf that you're worried about, then make sure you contact that account provider so that they can put a freeze on the card or the account so that you don't lose money. Many banking apps now on your current accounts, they allow you to freeze cards automatically through the app so that you can do that just until you find out if there's anything funny going on. But please, I would encourage you to report anything that you think might be a scam to Action Fraud. And that is the UK's National Reporting Centre for Fraud and Cybercrime. And check on your other accounts as well. Make sure nothing's happened there. If you feel that you have been done out of money, Action Fraud will help you with this anyway, but do advise the credit reference agencies. So that's Experian, Equifax and TransUnion, and they will take you through some additional security precautions that you can take. And lastly, if you genuinely suspect that somebody is using your identity, then you can contact the Fraud Prevention Service, CFAS, and they will put a marker on your credit reference files, and that alerts all lenders that you are at risk from fraud, and they can carry out further checks before any credit applications are approved. And the final thing I'll say on scams is it's really important to report any suspicion of fraud, because it does protect you in case there's any criminal activities with your accounts or your money. Now, the last part of protecting yourself against these lifequakes we're going to talk about today is making a will. Now, a will's a really important document. It tells people two very important things. The first one is who's going to have or who you want to have your money, your property and your possessions when you die, and that's known as your estate. And the secondly is your will set out who you want to be in charge of organising what you leave behind and following those instructions in your will. And that person's called an executor, and you can name one or more people to be the executors if you want. You can also use the will to tell people about things like instructions for your funeral or what happens to your pets after you've gone. Now, it's really important, particularly for everybody to have a will, but even more so if you've got a complicated situation, like you're not married, you're just living with somebody, or maybe you've got stepchildren or assets abroad. And that is because if you don't leave a will, or that will isn't accepted, the government will dictate what happens to your money, and that might not be in line with what you want. And for example, if you are just living together and you're not married and you're not in a civil partnership, then your partner is not entitled to anything if you don't have a will in place. The best place to go, I haven't put it on here, but is gov.uk. It's called the Law of Intestacy, and that sets out what will happen to your estate if you don't leave a will. Now, this is a really shocking thing, and I wish I'd put this on the slide actually. Last year, the government received £17 million in inherited property and assets because people had not left wills and told everybody around them who they wanted to get their possessions, and in those situations the government got the money. So a will not only protects your family and your heirs, it can also avoid the family stress of dealing with your estate at what's already a difficult time, but it also stops all of that money going to the government in the event of your death. Now, if you need some help with how to go about getting a will done and you're a member of the ICE Ben Fund, you can access some more information about wills and inheritance at the online wellbeing resources, and I've put the link here. I've also included the helpline number for the ICE Ben Fund too. And really excitingly, watch out next year, because there's going to be some information released about a new will writing service which is being introduced for members. So kind of watch this space on that one. If you're a member of Support Network, they've partnered with Law Express to give their members access to free legal advice 7 days a week. Not only do they give guidance over the phone about bereavement and wills, powers of attorney, but also on a whole host of other issues, such as employment, family and relationship difficulties. So when you call them, they'll ask you some questions about the nature of your inquiry, and then they'll match you to the best advisor. However, I just wanted to draw to your attention that there are many charities out there that offer a free will writing service. In return, of course, they hope that you're going to make a donation or a request to their charity. I've named a few on the slide here, but it is worth looking at the Money Saving Expert website, where you'll find a full list of the charities that take part. There's also Free Wills Month that takes place every March and October. And this is for those people aged 55 or over, and that's where you can get a solicitor drafted will for free. Again, also for a bequest to charity. It'll depend on what area you live in as to what month you can apply, but take a look at that site. And then very apt for this month is Will Aid. It's Free Wills Month. You go onto the Will Aid website, you put in your postcode, and it tells you any solicitors in your area that will provide a free will for you. I checked yesterday in my area. I live in Essex, and there were 8 solicitors near me to choose from. Now, if you do get a will prepared yourself, you can do that, but just make sure that you've met all the criteria. But you will need to store it, and you can do that online at the National Will Register, and you can do that for a small fee. You can keep it at home, but make sure it's in a safe place where it can't be destroyed, and also that your nearest and dearest know where to find it. And just to finish off today on protecting yourself against lifequakes, I've put up the details of the ICE BEN Fund and Support Network, who have sponsored the webinar today, and they can provide financial, workplace and wellbeing support to you and your families. So, please do use the contact details that you'll see before you. Right, Sarah, that's the end of the slides. Have we had any questions?
Thank you very much. There's a lot to think about there. First of all, should I be getting sick pay if I have been told to self-isolate?
Yeah, that's an interesting one. And I think the rules have changed over the course of the pandemic. But where we are now is that you must be paid at least statutory sick pay. So that's that baseline government pay, if you cannot work because you're self-isolating. So it might be that you've got coronavirus. It might be that you're not vaccinated and someone in your house has got symptoms or tested positive. It might be that you've been advised by the doctor or the NHS service to self-isolate. In any of those situations, you are entitled to statutory sick pay from day one of isolation. So it's not like normal statutory sick pay for a different illness where actually it wouldn't kick in until after 4 days. It has to kick in straight away. However, there is an exclusion to this. If you are having to self-isolate because you've chosen to travel abroad and then you need to self-isolate on your return, then your employer doesn't have to give you statutory sick pay. Now, of course, all employers could pay you more than that if they wanted to. It depends on their sick pay policy rules, but that's the very minimum. If you're self-employed, I don't think that you don't get statutory sick pay. So I think it's very unlikely.
That's great, thank you. Our next question is, my job includes an income protection scheme as a workplace benefit. How do I work out if this is enough cover for me?
Yeah, great question. We sort of touched a little bit on this. I mean, I think it's just working out, it's doing your budget. What is your absolute essential spend every month? And by that, I'm talking kind of your mortgage, your bills, your food, anything else that you absolutely have to have. An essential wouldn't be something like Netflix or Sky, because actually if things really did hit a bad place, you could cancel those, but you need to pay your mortgage or your rent because you want to keep your house. So work out what your essential bills are, and then work out how much you're covered for from your employer's income protection scheme. And think about, do I need to supplement that? But remember, if you do get an external income protection policy, and what you get through work and what you get through the external policy adds up to more than 60% of your normal salary, they're unlikely to pay out. So just make sure you don't over-insure yourself on that one.
That's great, thank you. And is it worth getting insurance to specifically cover devices such as phones and tabs?
Oh, now that is interesting. And, this is going to be a classic. It's really going to depend on your circumstances. So, of course, if you've got a pretty cheap phone, and some of the cheapest gadget insurance is kind of £6 a month, and if you add that up over the year, that's £72 over the year. A lot of them are double that price, so you're paying nearly £150 a year. What's your device worth? How long have you had it? Now, I mean, nowadays, a lot of us do have the newer Samsungs, the iPhones, they can be £1,000 to replace. And in those instances, then yes, it may well be worth getting some protection. Now, I get mine, I opt to cover mine through my bank account. I pay £12.50 a month for that, but I can cover all of my kids' devices on that. So we've actually, between me and our 4 kids, I've got 5 devices covered for that £12.50. So for me, absolutely worthwhile because I've got access to that. You might find the same. There's some a lot of bank accounts are including that, so see if that's an option for you. But all I would say is it worth it? Look at how much your phone's going to cost or your tab's going to cost to replace versus how much you actually pay out for it. And just make sure that you're getting like for like replacement as well.